This bond pays 6%. Sounds safe, right? Wrong. Some Singapore investors thought so, and lost everything. Hey everyone, welcome back to Wealth for You. Today we're diving into something you cannot afford to ignore. Corporate bonds. You've probably heard this at some point. Wah, this bond fund pays 6%. Better than Singapore savings bonds. But is it really better? Or are there hidden risks that could cost you your retirement savings? If you're a Singapore investor, especially if you're in your 40s, 50s, or nearing retirement, this is for you. Stay till the end, because I'll break it down step by step, no jargon, just what you really need to know. And if you find this useful, please like this video and subscribe to Wealth for You. It helps us reach more Singaporeans trying to invest smartly. Let's get started. Part 1. What is a bond? Let's start simple. A bond is like a loan. You're lending money to someone, usually a government or a company, and in return, they promise to pay you interest every year. At the end of the loan term, you get your original money back. Sounds safe, right? Well, depends on who you lend to. Part 2. What is a bond fund? Now, a bond fund is when you don't just lend to one company. You lend to 100 or more different companies or governments, all bundled inside a fund managed by a professional. So instead of putting all your eggs in one basket, you spread them out. This is called diversification, and it's one of the ways to reduce risk. Part 3. What is a corporate bond? A corporate bond means you're lending to a company instead of a government. So imagine you're lending to a water treatment company or a marine offshore firm. If the company does well, great, you get your 5% or 6% yearly interest. But if they collapse, your corporate bond becomes toilet paper. Part 4. Singapore's corporate bond collapse, a hard lesson for investors. Let's not talk theory. Let's talk real stories, right here in Singapore. In the past, many Singaporeans, including retirees and conservative investors, put their life savings into what they believed were safe and stable bonds. These products were marketed as investment grade, offered attractive yields, and were even recommended by some advisors. But the results? Disastrous. One of the most well-known examples is Hyflux, but it wasn't alone. Companies like Swiber, Ezra, and KrisEnergy also issued bonds that eventually defaulted or became worthless. All of them looked safe on the surface. All of them had investment-grade labels at one point, and all of them failed, causing thousands of investors to suffer huge losses. In many cases, total losses. Some of these collapses even triggered regulatory investigations and criminal charges, highlighting serious concerns about the quality of disclosures and governance behind these bonds. These cases remind us of some tough but important truths. Just because a bond is labeled investment grade doesn't mean it's risk-free. Even listed companies can collapse when business conditions turn. And being an accredited investor doesn't guarantee protection, especially if you don't fully understand what you're buying. If you're considering corporate bonds, remember this. High returns often come with high risks, sometimes hidden risks. Always do your homework, read beyond the yield, and invest only in what you understand. Because in the end, preserving your capital is just as important as growing it. Part 5. Why bond funds are safer. Now this is why bond funds are relatively safer. Let's say a bond fund holds 100 corporate bonds. Even if 3 or 4 companies default, the other 96 are still paying you interest. So your fund won't go to zero. It may drop a bit, but not collapse completely. That's the power of diversification. But wait, even bond funds are not risk-free. Part 6. Risks of bond funds. Now let's talk about the risks of bond funds, because not all bond funds are created equal. If a bond fund is heavily invested in high-quality government bonds, like U.S. Treasuries or Singapore government securities, it tends to be much more stable. In fact, during a recession, these types of funds often do better because people move their money into safe haven assets. So, these funds can actually help protect your portfolio in bad times. But here's where it gets risky. If the bond fund is mainly made up of corporate bonds, especially high-yield or junk-rated bonds, the story is very different. During a recession, credit risk increases. That means more companies might default on their loans. When that happens, these bond funds can drop 20 to 30% or more in price. That's why it's so important to understand what kind of bonds are in the fund you're buying. Here's what you're really dealing with. Credit risk, the chance that a company can't pay you back, and market risk. The price of the fund goes up and down as interest rates or investor sentiment change. So yes, while bond funds may sound safer than stocks, they're not risk-free. Also, here's a reminder, panic selling during a downturn is the worst thing you can do. If you sell when prices are down, you lock in your losses, and it becomes very hard to recover. Part 7. REITs and REIT ETFs. Okay, let's switch gears. What about REITs? REIT stands for Real Estate Investment Trust. They collect rent from shopping malls, offices, hospitals, and pay you regular dividends. Some REITs in Singapore give more than 6% dividend yield. But here's the catch. Their prices can drop too. For example, during COVID, many REITs crashed by 30 to 50%. But good news, blue-chip REITs like CapitaLand Integrated Commercial Trust, Fraser's Centrepoint Trust, Mapletree Logistics Trust have never gone bankrupt. And if you buy a REIT ETF, like Nikko AM Straits Trading Asia ex-Japan REIT ETF or Lion Phillips S REITs ETF, you get exposure to many REITs across Singapore and Asia. More diversification equals lower risk. Part 8. So, what should you do? So, after hearing all this, you might be wondering, what should you actually do with your money? Well, it depends on two things. Your comfort with risk and what kind of returns you're looking for. If you're someone who absolutely cannot afford to take any risk, maybe you're near retirement or just want to preserve your capital, then keep it simple. Stick to fixed deposits or Singapore savings bonds. They're backed by the government, the capital is safe, and while the returns are modest, around 1.9 to 2.5%, at least you can sleep well at night. Now, if you're looking for passive income and you're okay with a bit of price movement, then REITs could be for you. You can go for REIT ETFs like the Lion Phillips S REIT ETF or the Nikko AM Straits Trading Asia ex-Japan REIT ETF if you want diversification. Or you can pick a few blue-chip REITs yourself, like Mapletree Logistics Trust, FCT, or CICT, if you're confident in doing your own research. These options typically give you around 5 to 6.5% dividend yield, but do expect some short-term price fluctuations. Now, if you're really chasing a higher yield, maybe 6% or more, and you understand that there's real risk involved, then yes, you can explore bond funds. But here's the warning. Not all bond funds are safe. Stick to diversified ones and avoid jumping into high-yield bond funds without understanding the credit risks, especially during a recession. Because when defaults happen, these funds can fall sharply, and panic selling can hurt even more. So, in the end, there's no one-size-fits-all answer. What matters is, do you understand the product? Can you handle the volatility? And most importantly, can you hold on when markets go down? Because if you panic every time prices drop, even the best investment won't work for you. Invest within your comfort zone, and you'll be just fine. Final thoughts. If you don't understand corporate bonds, don't buy them. Don't let any insurance agent or banker sweet-talk you into it. Even if it's investment grade, remember? Hyflux was too. Stick to what you understand. Invest within your circle of competence and your comfort level. And remember, in investing, it's not just about return. It's about return of capital. Make sure you can sleep well at night. If you found this helpful, please like, subscribe to Wealth for You, and share this with someone who might be considering corporate bonds. This is Wealth for You, helping you grow wisely, not recklessly. Thanks for watching. See you in the next video.